in challenging times, there's always change. The status quo works until it doesn't. So I think inevitably people are going to do things differently. And I would bet that the people that are doing things differently are the people that don't have, 5 billion under assets. It's always like the incumbent versus the challenger. And I think during those economic times, I would bet on the challenger. And I would say emerging managers are the challengers.
Elia, welcome to the Slice Pod, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You are the founder and managing partner of Forma Capital and partner and CEO at Cashmere, pioneering public venture fund investing 200 to 1 million in early stage private companies across multiple sectors with a unique thesis around compound influence. Your fund is breaking new grounds by democratizing venture capital investment and allowing retail investors to access venture returns with twice yearly liquidity options. So quite different from the 7 to 10 year VC venture cycles. So let's begin where we always do around here, which is by asking, how did we get here? Was this always the plan? Were you always going to run your own fund?
Yeah, that's a great question. It was definitely a no. So I started my professional career at Endeavor, the talent agency, in 2000. Was there for almost 2 decades. The second part of my career there, I kind of had a little aha moment where I represented talent. The company represents talent. And at the beginning of kind of social media, I realized, wow, these guys have influence at scale. And very few of them kind of knew how to bottle that influence and really make something valuable out of it. I was very lucky to be at the right time at the right place. So I kind of started doing that a little bit more on the incubation side. I helped a friend of mine put together his family office. We made some investments there. And ultimately, I took the leap of faith in the worst possible funding environment for venture capitals, which was about 2 years ago, when we started Forma Capital. And it was great. I had 4 partners in Forma Capital. Josh Allen also joined us later. Obviously, there were fundraising challenges. And maybe I'm getting ahead of the question, but it was like kind of, I would say, a 2-step aha. It was like, one is like, oh, wow, incubating brands and making brands with influential people, to me, feels like a solid thesis that is going to be a business model for a decade plus. And then 2, how do you move from incubation to venture, which we did in the last few years successfully, which is good.
What was it? Michael Hovitz famously sort of pioneered the Andreessen model and brought a sparkle of entertainment up in Silicon Valley. What are the similarities between the two industries, and what pieces of the entertainment world you bring with you into the venture side that you can find do you find there are similarities? Do you find that there are like things that help you get the job done better than others? Or is it just a matter of like, plugging in the influence from the talent that you represent and the talent that you're connected to into the companies that you invest in?
Oh man, that's a question that we can spend an hour on. I think actually there are quite a few similarities between entertainment and venture. One is they're weirdly highly inefficient, right? Like they're very much like people relationship, handmade. Everything is kind of like one investment or one movie is a custom project, and there's very little repeatability in a way. So I think it's kind of interesting in that respect. From our thesis is we invest capital and influence, right? Both at Forma Capital and at Cashmere. And what's great about us is I really come from entertainment. Some of my other partners really come from the sports space. Like when you really look at like when you want to source or deploy influence, and that can mean either from an athlete, from a celebrity, from a league, from a sports team, from an et cetera, like you just want to have really good data. Like who are you partnering with? Have they had a track record of success? Who are the people around them? Who are the managers, the agents, the people, the head of licensing? And, have you worked them before? Are they reliable? Are they going to show up? Are they going to post when they need to post? Are they in it to win it? Or are they just kind of doing what's written in the contract? And we just think that we have better data in that respect, and really knowing like the athletes and the celebrities personally, but also knowing everyone around them and their ecosystem. And that also holds true for like NFL teams or college teams with like NIL deals. Unfortunately, it is all very handmade. I'm kind of shocked when I really went into venture in the last few years. It still feels highly inefficient, which is a great opportunity, right? It means that there's a ton of room for kind of growth and for especially emerging managers to really figure out like how to be nimble and take advantage of what the world has for us today.
Let's talk about that. Like, you talk about emerging managers. Do you see that there is a difference, a change of guards, and like, the ability for a new class of managers to come to the marketplace with a differentiated offering?
I think in challenging times, there's always change. The status quo works until it doesn't. So I think inevitably people are going to do things differently. And I would bet that the people that are doing things differently are the people that don't have, 5 billion under assets, right? It's always like the incumbent versus the challenger. And I think during those like economic times, I would bet on the challenger. And I would say emerging managers are the challengers. I think there's more hunger and there's more way in trying to figure out like, all right, what's the different interesting angle today? We don't have 100 million or a billion under management, and we got to be scrappy and we got to figure it out. And we have a thesis. I definitely do think that it's going to be a time where like challenging times bring out kind of new players with great ideas that will lead to really big fun.
How did it transition from Forma to Cashmere? Like, and I know there was a bit of an opportunity on the table and you guys jumped on it, but at the same time, what was the thinking behind it and why pull the trigger on the opportunity in itself? And why not start like a more traditional kind of like, or continue in the footstep of Forma and just kind of like, raise from more traditional LPs like high net worth individuals, family offices, and this kind of stuff. Like, was it the downturn that forced you into that spot, or was it the opportunity? Was it a combination of both? Tell us a little bit about that.
We were ready and hoping for it. So we were raising for Forma. Again, challenging time, but we're kind of on our way. And we got a call, I think it was in January of this year, from Emma at Sweater. And they were sourcing, I don't want to speak on their behalf, but I think a little bit of their strategy is they're really betting that the interval fund class as an ecosystem is going to grow. And they really want to become kind of like the advisor and find some advisors to build that ecosystem out over multiple funds. So their strategy is a little bit like have multi funds within their portfolio and they power all of them. And they started the Cashmere Fund really as a proof of concept of saying like, look, we can go raise this. We have the technology to create a one-to-one relationship with the investors. They can come to our site, they can invest, they can do all of that. So there was a big kind of tech lift up front that they had. And then at a certain point, they kind of validated it and they raised the fund to a significant level. And they said, all right, we need to find a partner. We got the call. We had a meeting the next day between our partners at Forma. We're like, this is super interesting. Like it was a no-brainer to us. I think we probably played it a little bit safer to them being like, oh, I don't know. We'll see. It's maybe interesting. Maybe it's not. But in our mind, it made perfect sense. And the reasoning for it was Forma Capital, again, deploys capital with influence. We think we just have better data and we can find the best kind of influence investor piece or partner piece to power the portfolio company and hopefully kind of alter their trajectory in some way and have a higher exit. When we started to Cashmere, what we realized something that they have, which we could never achieve in a traditional venture ecosystem, is they have thousands of investors with the ability to get to tens of thousands, hundreds of thousands, millions of investors. And that to us feels like such a powerful influence lever that we could have never had in a traditional kind of venture capital 2 and 20 model under the regulation that we operated Forma under, 99 max investors, et cetera, et cetera. And really just another lever. And that's how we kind of got to the idea of like compound influence. What happens when Josh Allen is the GP of the fund? And what happens when you have 5,000 investors today who are true evangelists of the companies that you invest in, have like real upside and also potential perks of like, you're an investor in this company and you have a discount in the companies, in the brand that you invest in. You can go to dinner with your friends and tell them about the company that you own and the products that you described with them today. So that was something that we were never going to achieve in the kind of current construct. And to be fair, they said like, do you want to build your own? And we looked at the fund, the Sweater Cashmere Fund at the time, and we looked at their portfolio and two things struck us. One, we thought they made great investments. And then two, and this is something we realized even more later, is they really had a quite diversified portfolio. I'd say like 50% consumer tech, and 50% in healthcare, SaaS, et cetera. And to us, it felt like if only the 1% of the US currently has access to venture capital, right? And we want to give access to the other 99% through this model, we probably want to give a more diversified portfolio than what we had at Forma, which was really like sports, health, and wellness and very specific to consumer. So I think we were immediately attracted by kind of that piece of the influence from an investor base, but also how diversified the portfolio was.
How big is it going to get? And how big are you going to allow it to get? I love diversification, but at some point there is dispersion. And that's not good either. Like, is this going to be like an evergreen type of thing, or are you going to do different vintages?
Cashmere is an evergreen fund. Our goal is we have over 5,000 investors today. Our goal is to get to 100,000 investors. The minimum investment is $500 in the fund. We're really looking at number of investors over AUM, but obviously there's a direct correlation of those. I fully hope that after this podcast gets released, we get at least halfway there. So thank you for doing this for us. I think the power in the portfolio, in the number of the portfolio investors is the most important thing. We want to create a community where people have the ability to invest. Like you look at what like Robinhood did early days, that was game changing and amazing, right? Like now there were other things that came out of it that were maybe not super positive and they created bubbles and like some people also lost a lot of money. But the true idea of it at its core was absolutely brilliant. And I think we're in a position where we can replicate kind of the mentality of what happened back then of like venture capital is a phenomenal asset class that 90+% of the people in the US have never had access to. And if you look at any kind of sophisticated manager at JP Morgan, et cetera, they will tell you, you should have a position in venture capital. So our position is, can we bring 100,000 investors, have venture capital be part of their position? It can be 0.5%. It can be 5%. You know, it shouldn't be 50%, right, of their kind of portfolio management. That's really the goal. As far as, you know, is there a future Cashmere fund? We love the idea of it, right? Right now, we're really looking at our fund as 50% consumer and consumer tech. We love that because of the partnerships that we can bring. Most of the kind of influence really applies to the consumer space, right? Like they can see it, they can feel it. You got an influential person or a league or something. It's just an easy thing. It's much harder to do in healthcare and SaaS and kind of categories that like are kind of more B2B. Do we love the idea of doing specific funds, evergreen funds like Cashmere in specific verticals? 100%. But goal number one, 100,000 investors in Cashmere.
How do you get the deals? How do you find these founders? Do they find you? Are they being sent to you? Do you reach out to them cold on LinkedIn? Hey, I got 100,000 people that would love to invest in your company. Give me a space on your cap table. What's the process? Because you're quite an outsider in the way that you operate, and so I can imagine eventually you will be invited into a lot of rounds. But like as of today, where do the deals come from?
We've been lucky because as the 5 partners, we've been angel investing for kind of a decade plus each. So we definitely had our networks of kind of deals, and in different capacities, we've been quite successful doing it, and then have been investing ourselves. In the Cashmere fund specifically, I'd say it's a combination of all of that. I think right now we're really hoping to continue to work with the venture capital funds that we've co-invested with. Most of our capital, we do not lead rounds. That might change if the size of the fund goes up considerably quickly. And I think most VCs have seen in us a value prop that they don't have that is highly beneficial to their portfolio companies. So what we've experienced is we get the incoming call from the great VCs saying, I think this company should have you on the cap table because you provide a very specific kind of value add that is very rare, right? We've also had, and again, this credit to the Sweater Cashmere team that ran the fund, right, until a couple of months ago, is they also activated their retail investors with the brands, and those brands love it. So those brands then recommend us to the venture capital funds because they're like, well, these guys are great. So we're lucky that we're in the incoming phone call business. As we raise a little bit more, my guess is we'll be a little bit more proactive in figuring out the categories that we want to be deeper in.
LP side, like, how do you communicate all of this to like an unsophisticated? Because I definitely agree with you that, you know, it should be part of every balanced portfolio. It shouldn't be 50%. I guess I'm screwed in that category because I'm probably well over 99.9.9. But I do see it with regular run-of-the-mill, high net worth sort of LPs that are not used to investing in the asset class. Like, you know, there are some quirks and features that come with it that have to be explained, let alone to like traditional retail investors. Do you find that they come to you fully understanding of what you're up to? Obviously, you have a very different model. There is twice yearly redemption windows and so on and so forth. So it's a little bit less illiquid than your traditional 10-year lockup for a regular fund. But yeah, do you do any education for the LPs? Do you see that people are just smarter? Maybe they're younger. What's the average like of these 5,000 people that you have on board? Who are they? Do you have an idea of like, what's the makeup of this demographic that you're reaching out? Similar to like we were talking about Robinhood was able to tap into like, a retail market of investor that wasn't traditionally in the public markets. Are you reaching an audience, a demographic that it's not in venture, or is just like a bunch of founders and, technology folks that maybe they don't have exposure, but they know what they're doing, they know what they're getting themselves into?
Yeah. Another question that we could spend a few hours on. The education piece is massive. There's a lack of education around alternatives in general and venture capital within it. And that's something that we're trying to figure out. We see the growth of our fund tap in two ways. One is through just direct investments, right? So like you can come on Cashmere fund site, you can drop a minimum of $500. You'll have a diversified kind of investment in our fund. Number two is we're going to lean quite heavily in doing distribution partnerships with banks and fintechs and RIAs and wealth managers that really have a portion of their investors that want to have access to venture. But again, a lot of them don't want to put a minimum of $100,000 or $250,000 into an asset class with a 10-year hold. And we have the beauty of not having that. So I think a lot of that communication we're doing directly. So if you kind of come on our site, there's some literature around like, why is venture interesting, et cetera, et cetera. And we'll certainly do a lot more of it in advertising and on our site. What I think we're really excited about is doing it with partners too. We're seeing kind of the retail investor pull of going to a lot of these banks. For example, like SoFi, they did a big alts push like earlier this year. And there's a bunch of other partners that are doing the same, where they were like, oh, wow, well, like we realized like Robinhood almost opened a can of worms, right? Where they actually show the retail consumer, wow, you actually have choices. Before it was just kind of like, you have your 401k and you kind of do your thing. And then like eventually, you're 60 years old and hopefully you put a lot of money aside. And now there's kind of a different path. And some of it is really risky paths, which we would not recommend. And we think we're a safe path in the sense that we're SEC registered, we're highly regulated, we're diversified, et cetera, et cetera. And that's open now. I think the education piece is the hardest piece of it. We do have the advantage of having kind of influential people and leagues and teams be in our ecosystem. So what we'll really probably try and do is leverage the power of those voices who have like very kind of high top of funnel awareness to educate consumers. So one, really trying to do it through those partners who also have like established presences, right? These are banks that have been around for 30, 50 years, right? That people have like understand like, oh, wow, that's an authority, right? So doing some partnership with that. I think it really comes down to that. I think education is key. And like, I think if you ask anyone today and you do a random survey of like, how much do you know about alts? Do you even know what alts mean? Or, do you know what the mechanics of venture capital fund? I think the response is so low. It's so depressing. And we got to do better.
Just for the sake of whoever is not familiar with your structure, give us a little quick rundown about kind of like how Cashmere differs from the traditional venture model in all its aspects, like, the twice yearly redemption, the minimum check size, the regulation piece as well, et cetera, et cetera.
The kind of the interval fund space happened around a decade ago-ish, where the SEC basically said, hey, we're going to regulate you. So you're going to have a much higher standard on what you can say, how you can market, how you value the assets very transparently to the market on a quarterly basis, which is a pain, right? It's an expense and you have to go through it. You have to have higher compliance costs and admin costs and et cetera, et cetera. In exchange for that, we're going to let you advertise to non-accredited investors. And that's the number one kind of thing that changed the playing field, right? Which means you don't have to have a maximum number of LPs. So in theory, like in a venture capital fund, you really want to have less investors, higher check sizes. You invest in a kind of small number of companies. And in an interval fund system, it's totally the opposite. You want the highest number of investors. If they write a $500 check size, that's fantastic. And what the SEC said, like as the most important thing is you need to have yearly redemptions so that like if that unaccredited investor comes in and, they invested too much, like they have to have the ability to have liquidity within the year. So right now, how our venture fund is structured, is we have twice yearly redemptions and we have distribution windows depending on the performance of the fund. So there's really actually 3 moments in the year that a consumer can potentially have. Right now we're structured in February, August, and then distribution end of year. So there's really 3 moments where the consumer can say, hey, by the way, I had an unexpected expense. I want to redeem part of my portfolio. And by the way, there's no penalty. There's a minimum hold period, which I believe is 12 months for us now. And then beyond that, if you want to redeem out, you redeem out with your profits, right? If there's profits, there could be a loss. But a true market value, right? So it's like at the value of the fund, there's no 401k 10% penalty. It is a true, you're vested. So it's kind of a totally different dynamic. And now there's about, I think, 90 interval fund in the US. It's about 100 billion asset class. So it's small, but it's not that small. It's growing very fast. We love it because I think it gives non-accredited investors an ability to get into venture. We've been lucky to have been successful in ventures as individuals. We think it's an amazing asset class. And I think the SEC made a phenomenal move. And you see a lot of big institutions starting their interval funds. And you see a lot of big banks like trying to bet on them because I don't think this is a wave that will come and go. I think this is a kind of a considerable momentum that will continue to grow because it's being set up the right way.
Yeah, there's usually a lobbyist involved in this kind of thing, I'm pretty sure. Let's talk about the relationship that you build with the founders that you invest in. What is the value add that you bring? If it turns out to be true, like, the voice will spread and the word of mouth will be very strong. Do you spend any time with these folks? Is it a push or is it a pull? How do you manage it? Because this portfolio could grow exponentially very quickly. How do you stay on top of all the investments that you made, and how do you make sure that every founder gets the value that they were promised with their check from Cashmere?
Yeah, that's a great question. Let's pretend we started this company 2.5 years ago, right? And let's pretend that we have a portfolio of 35, 36 companies. First of all, I'd say there's a subset of those companies that we really don't, we add value as venture capital investors. So follow on rounds and, staying on their strategic advisory help, but the influence piece of it does not come into play, right? So it's like, I would say half the portfolio is gone. We have a small investment in 4 funds. So we have a little bit of a funds of funds business. And that's also really kind of not applicable in the influence side. So I'd say there's a dozen to dozen and a half companies that I think are really relevant for us. And to date, it's really been like get on a Zoom with the founders and say, how are you doing? Can we help? It's been kind of as organic as that. And some of them have been great. And there's been some amazing conversations happening with, Graz Olive Oil and IQ Bar and Solar Core. And they're great companies that also have some scale and kind of at the right place and in their trajectory and said, we're doing what you are really good at doing. Let's do it together. Right. And the positive for them is like, we're an investor. We're not an agent. We don't take a commission. We are just incentivized to build value in that company and for that company to become successful and eventually exit, right? Like that is our only incentive. We're not middlemen. We're not agents. We're not brokers. Like we are fully aligned with changing the trajectory of their company. We have 37 investments today. We'd love to scale the investments to 100 plus. And that's the beauty of an interval fund. You have a bigger back office, a more expensive back office. That is what the SEC requires of you. It's a pain. The plus side is you have a lot of bandwidth, right? We don't want to be stuck at 35 companies or 37 companies. We want to get to 100 to 200 companies. And how do you handle that? Well, the good news is if we get there, that means the AUM of the fund will be a lot higher and we'll be able to hire dedicated people to do that. I would say kind of as simple as that. Again, we're not the people that are doing it. We're not the brand. We're the facilitators of it. And we don't need to do the hand holding from day one till the end. We can come in, we can be very surgical in figuring out like, okay, this is the demo. This is the value add. This is probably the right person. Go do some research, make the introduction, make sure that the right conversations are happening and really let the brand take it over. We are not the brand. We're not the operator of the brand. We believe in the brands that we invested in, and we believe that the CEOs and founders and head of partnerships and chief marketing officers are going to do what's best for the brand. So in some respect, it's come in, do the right thing, get out of the way. Let the brand that you invest in do the right thing.
I know you're very early in this journey, but with Forma, you had a bit of a ramp up to what being an emerging manager feels like. What would you say are the biggest hardships of this job?
It's a good question. Fundraising in 2023 and 2024 for Forma was not fun, right? It was a challenging time where people could easily get 5 to 10% returns in either government bonds or highly liquid assets, and try to compete with that was really hard. So that's number one. I think that's just kind of universal. Two, for us, I'll talk about it not in the point of view of Forma, but really in the point of view of Cashmere, is being an emerging manager. Like, I think there's like, if you look at the pros and the cons, I would still bet on the pros, right? There's a lot of pros, right? The hunger and the way of doing things differently, and the dedication and the working 80 hours a week plus, and the way of just making something that cannot fail. Like, those are all the pros. The cons are, you're still going in an ecosystem what you like, you don't know what you don't know. And I think we try to be very aware of that and surround ourselves with partners that we think could really solve for those problems and see kind of like ahead of the curve, right, for us. I'll tell you the third thing, which is kind of the obvious, is there's just a lot going on. It's, we're 5 partners. The hours a week is a light week. And we're trying to figure out how do we make that sustainable? How do we use AI? It's going to be an incredible tool for all of us. If you guys have suggestions, I want to know. Like, you brought one into our ecosystem, which we love, by the way, which we're scheduling through.
Shout out to Kais. What are the rituals? You mentioned a little bit of the tools, like Blockit, and I'm sure there's like a bunch of others. Hugo last week also recommended texts, which I'm also heavy users of. Happy to get you on board on that one too.
Send it over. I want to know.
Will do. But what are the rituals among you guys partners that you follow? What is the cadence? Not just you, it's kind of an anomaly. It's a small firm. I'd imagine it's very crafty. But do you have like rituals in place to sort of keep a beat, or does every week look different from the other one?
We wrote a memo together as a partnership a few weeks ago, maybe a month plus ago, and it was a terrible name, I'll tell you anyway. The title of the email was called Max Efficiency. And it was, how do we get every ounce of our day to do the most possible? I'll tell you what my day looks like is I wake up, I respond to anything that's timely. I read the news. There's like 2-3 great blogs. I have an entertainment blog, I have more of a tech blog, more of a VC blog. I kind of go through Morning Brew, kind of go through kind of my list quickly, depending on how much my kids let me do it or not. And then my day from 9 to 4, it's just back-to-back Zooms. There's no break. You're just on it, and you're trying to do 7 things at the same time. And then our real brainstorm time actually happens from like 5 to 10 p.m. It's like the time that we can like put our phones down and be like, all right, like, we're talking about like launching a significant partnership with a bank to distribute our fund through that will happen in the next couple of months. I think it's working pretty well for us, but again, we want to try and be more efficient. And we also know that like 8 blocks of Zooms back to back are just not efficient. So like, how do we change that, or how do we minimize it, or how do we divide and conquer? I think the tools I think we're not behind the curve, but we're not ahead of the curve yet. Right. I think with scheduling, like, we were still kind of in Calendly, no disrespect to Calendly, great tool. We're moving on to Blockit. I think it's been awesome for us. We want to do more automated marketing. I think that's a place where like we do want to put a lot of education out, and how do we do it kind of on a more automated way. We have an amazing ad agency, and we haven't dipped into automated SEO and kind of like really kind of marketing tools. We're obviously doing Meta and Google and kind of all the usual suspects. But like, I think automation and marketing is coming, has come, is here, is coming, and we want to do a lot more of it externally facing. And yeah, internally, let me know your tools. I feel like you're really ahead of the curve, so I want to learn.
Out of necessity, I'll send you a couple invites to a couple good things. But what is
Please.
a piece of advice, of your advice, that you would give maybe to yourself a couple of years back, at the beginning of this journey, and you're like, hey man, like, these are the things that you need to watch out for. That today, I know you're not thinking of it. I've learned along the way. And what are those either challenges or obstacles, or like even like, unexpected happy moments that you witness in this transition from your past life into this new life, what's the most striking that comes to mind?
It's a great question. We're effectively a direct-to-consumer venture capital fund. The roller coaster is pretty crazy. The lows, as much as they feel like, oh my God, there's this unsurmountable object in front of us, it's going to derail our company. It's never that bad. And to celebrate the wins, because those are meant to be celebrated. It is a rock up a hill. Like a new business is a rock up a hill. That's what it is. And you're a team, and sometimes you're doing it solo, or sometimes you're doing it as a team, and it's hard. If it's not hard, it's probably not a business, right? But don't take the lows too hard and really celebrate the wins. That's the advice I'd give myself.
I love it. Are you going to follow in the footsteps of that advice? Because I think every single guest we had on this podcast today has mentioned that the one thing that they should be doing is celebrate the wins. And I have a feeling that nobody really is doing it. So maybe I should put you guys all together and you can force yourself to celebrate each other's wins or something similar. Speaking about other folks, who are other emerging managers, just like yourself, with a diverse background that you look up to, if any?
That's awesome. That's a great question. On the manager side, I would say, I'll mention someone that I probably haven't spoken in like 6 to 12 months, but you look at like Willow Growth Partner was someone that brought us in a couple of their deals pretty early on. And Deborah was so grateful to us when we were starting. Probably haven't spoken to her in a year. So hopefully she sees this at some point, and this is my thank you to her. Like, one, I think they've been quite successful, which is just awesome. But two is when we were starting Forma, a year and a half ago or 2 years ago, I can't remember the exact date officially. And I gave her a call and I said, hey, I'm starting this fund. I have these partners. This is my intro. And she was so grateful. And she's like, let's co-invest together. Let me help you. She was still an emerging fund. And at the same time, she's like, let me help you out. But for the people that don't know her, she's a rock star.
We'll be sure to get in touch. Speaking of which, how do people get in touch with you? Do you even want them to? I'm sure that, there is a very rigorous process on the LP side. I'm not even sure that you can even pitch it directly to people yourself. But let's say that I'm a founder in the direct-to-consumer space, or in overall sort of like a consumerish thesis. And I think that I would love to tap into that compound influence that you're selling. Do you approve of a cold inbound?
The short answer is yes. The longer answer is we've been hesitant to open that channel because we've been kind of relaunching the fund. So we kind of turned off the spigot and we removed the email from the website and the wording of like, reach out to us for anything. We definitely want it. And we're definitely public on LinkedIn and kind of in other mediums. And there's a form that one can submit to get in touch with us.
What's the website? Elia, thank you for the conversation. There is one sort of question that we ask everybody all the time. To wrap things up, which is, what is the one thing that we missed? And, we're going to wrap up this call. You're going to walk away from it and be like, damn it, I prepared so hard to answer this question and Fabri did not ask it to me. And now the people will not know what's in my head and I want to share with them. What is that thought?
I'm going to paraphrase Sarah Thompson, who's I don't know her title now. She was global CEO, I think, of Droga5, which is an amazing ad agency, which I worked with when I was at Endeavor. And she said a version of, believe your own bullshit, which always stuck with me. She told me like 10, 15 years ago, it was a transitional moment in my life where I was kind of going from agent to kind of like more entrepreneur incubator. And when we started the beginning of the process of Cashmere and then eventually Cashmere, we really believe our own bullshit in the sense that I think that there is this massive disconnect between what the world of venture has provided to very, very rich people and has performed incredibly well over the last 3, 5, 10, 20 years. And the very, very few people that have access to it, right? Like if you look at, there was an SEC stat that the SEC put out like 6 months ago or 9 months ago, saying less than 1 out of 5 people are accredited investors in the US. I think it was like 18% or something. And then if you start thinking about that 18%, how many people have like minimum check size of 100 grand and let that roll for, 10 years, you're probably looking at like 1 or 2% of people that really have access to this amazing kind of asset class. And we feel pretty convinced that this is an area that's going to grow and we're pretty lucky to be in it. and we really believe are bullshit in the sense that like most people should be diversified in venture, and we're one of the very, very few solutions that is doing it, and we really believe that we're doing it the right way.
I really appreciate your showing up and telling your story and sharing how different your model is, and how we can innovate in ventures in ways that are unexpected. You know, like Steve Jobs used to say, don't let a good crisis go to waste. And so, well, the last sort of economic cycle has generated the opportunity for like folks like you to jump in and grab the bull by the horns, essentially. So, best of luck with the running of the Kashmir Farm, which is on the early innings of your journey. But I'm sure this is not the last time that we're going to hear of you, or that we're going to have you as a guest in this venue.
I love it.